Hello everyone, this is Arnaud Delapierre and I hope you're doing well. Today, we're going to discuss an incredibly vast financial scandal, the manipulation of the Libor, this famous benchmark that affects our interest rates every day. For several decades, this topic remained unknown to the general public, while it influenced our mortgage loans, credit cards, and many other banking products. In this video, I will explain how institutions managed to rig this standard and especially why this concerns us all. Make yourself comfortable, because we're going to revisit an episode that shook the international financial sphere. The Libor, acronym for London Interbank Offered Rate, is an index generated every day by compiling the interest rates at which a group of banks grants loans to each other. It was long considered an essential benchmark as it influenced the cost of many loans and financial products. Its scope covered enormous sums in the global economic sector. When we hear about banking scandals, we often think of speculative operations or accounting errors. In the case of the Libor, it goes beyond a simple slip-up. There was a deliberate arrangement to alter these rates for gain. To fully understand the scale of the scandal, let's briefly look back. Libor began to build a reputation in the 1980s when it was officially adopted to facilitate exchanges between international banks. Over time, it became a pillar for calculating the costs of various financial products, ranging from simple student loans to more complex derivative products. Its mechanism seemed transparent. Each day, a panel of banks was asked the rates at which they lent money to each other. Then, an average was drawn from this, which served as a reference. Everything seemed perfectly fine. Before getting to the heart of the matter, I will make a brief aside to tell you about an application that can simplify your life if you follow financial markets. It's called Notrade and it's free. On iOS and Android, the interface is designed to send trading signals in a simple and targeted way. We receive clear alerts without being overwhelmed by a ton of complex information. It's pretty clever not to miss an interesting opportunity in the markets, especially since the app offers daily help to track stock market fluctuations. Some users find it really handy, so feel free to take a look. I use it myself. Let's return to our main topic. How was this manipulation discovered? Well, it was starting in 2007-2008, when the financial crisis began to shake the markets, that attention on financial flows intensified. Some observers found it strange that the rates reported by certain banks did not reflect the reality of tensions in the interbank market. Little by little, journalistic investigations and official inquiries uncovered questionable practices. That's the least we can say. Employees raced, revealed the existence of internal directives aimed at skewing numbers to secure gains or mitigate certain losses. The list of banks involved is not short. Barclays, UBS, Royal Bank, Scotland, and many others ended up with record fines. Investigators got hold of emails and internal discussions where traders openly asked their colleagues to alter the rates. The objective: improve the profitability of certain operations while minimizing the risk of loss. This kind of practice had a direct impact on large-scale finance because by adjusting even just a few basis points, massive amounts were moved. In the end, this little game lasted for years in the shadows. Each morning, the panel of banks submitted figures supposed to reflect their own borrowing cost, except that in many cases, this data was manipulated internally under the pretext of adapting to the market. Intercepted conversations revealed that some traders agreed the day before to raise or lower the rate. It only took several institutions aligning to steer the average to their advantage. This mechanism, repeated regularly, eventually distorted the entire reference system, generating cascading effects on various investments. Investors businesses, and even individuals then paid the price of distorted information. When the authorities understood the extent of the problem, they launched large-scale investigations, heavily sanctioning the offending institutions. Barclays was one of the first to acknowledge the facts, incurring a hefty fine and making headlines in numerous newspapers. Other banks followed, each paying amounts reaching hundreds of millions or even billions of dollars. Beyond the financial sanctions, trust in these institutions has been seriously undermined, one could say. Many clients wondered if their bank was truly trustworthy, and the banking sector found itself under pressure to review its rate-setting methods. This issue does not only concern finance professionals. When Libor was manipulated, it influenced the interest rate on regular loans, mortgages, student loans, or even the variable rate applied to our credit cards, which were very popular. Changes in Libor could make monthly payments rise, or, on the contrary, offer an artificial respite in some cases. In reality, consumers and the general economic fabric suffered, since many contracts actually relied on this scale. From pension funds to small entrepreneurs, no one was safe from the repercussions of these manipulations, which were done in behind the scenes. In response to this controversy, the regulators felt a need to review the system from end to end. Discussions were held to change the calculation of the Libor, or even introduce other, more reliable references. In some countries, a complete replacement of Libor with a new indicator, less susceptible to manipulation, has been proposed. The Financial Conduct Authority in the United Kingdom has indeed imposed stricter rules to regulate rate declarations. The banks, now on the hot seat, have multiplied mea culpa statements and promised to improve their internal verification processes. This case was not limited to the United Kingdom or the United States. Other financial markets in Asia, in continental Europe, investigated their own rate-setting methods. Some findings have been enormous. There was an incredible scandal. When an index of such importance is biased, the repercussions can extend far beyond borders. With markets being interconnected, a distortion in one place can lead to unexpected consequences elsewhere. This has increased analysis and prompted many analysts to advocate for greater transparency in the finance. Consequently, several companies and investors filed lawsuits against the banks involved, claiming to have suffered damages. Class actions emerged, particularly in the United States, bringing together thousands of plaintiffs. Some financial products straight from the securitization departments depended directly from the Libor. To calculate their yield, when the rates were artificially inflated or lowered, these investments could lose all coherence. The courts therefore had to decide on highly complex cases. Some major institutions preferred to settle amicably, paying high compensations to avoid the uncertainty of lengthy trials. Resounding. This scandal highlighted the fact that even in a regulated environment, it remains possible to bypass the rules if the desire for short-term profit prevails. It sparked a debate on corporate governance, internal culture, and individual ethics. When bonuses are linked to performance, some professionals might be tempted to manipulate indicators to inflate their results. This case exposed the fragility of a system based on voluntary declarations rather than on real data. Finally, we all understood that international cooperation remains essential to ensure the proper functioning of markets. Today, the Libor is being phased out, replaced by new benchmarks like the SOFR in the United States or the SONIA in the United Kingdom, SONIA. The idea is to rely on more tangible data from actual transactions to limit manipulation. Even if many feel that this effort has taken time, we now see a stronger desire to avoid repetitions of the past. However, some observers remain skeptical, believing that the culture of quick performance has not disappeared among some players. In any case, the Libor scandal will remain a significant example in the history of finance. Here we are at the end of this story about the manipulation of Libor. This episode reminds us that even the largest banking institutions can fall into dangerous misconduct. For all of us, it is a warning signal. Stay vigilant with financial information that are presented to us, and do not hesitate to dig a little deeper. If you like this video and want to support me, consider subscribing to the channel and leaving a little thumbs up. Thank you for following this story with me, and I'll see you very soon for new financial scandals.